You have been told a story about inflation your entire life. The story goes like this. Inflation is a problem, a malfunction, an unwanted side effect of economic mismanagement that responsible governments work hard to prevent, to control, to eliminate. When inflation rises, officials express concern, they convene emergency meetings, they raise interest rates, they issue statements about their commitment to price stability. They perform the role of doctors fighting a disease. This performance is very convincing. It is also, at its foundation, a lie. Not a lie in the sense that inflation causes no harm. It causes enormous harm. Not a lie in the sense that officials don't sometimes genuinely try to reduce it. But a lie in the most important sense, the sense of causation, the sense of origin, the sense of who designed the system and what they designed it to do. Because here is what the performance never addresses. The modern monetary system does not produce inflation despite its design. It produces inflation because of its design. Inflation is not the fever, it is the function. The system was built in 1971, deliberately restructured around a specific mechanism, and that mechanism requires a continuous, permanent, never-ending erosion of your purchasing power simply to keep operating, not as a side effect, as the engine. In this video, I'm going to show you exactly what changed in 1971, precisely why the system needs inflation to survive, and what that means for every dollar, pound, or euro you have ever saved, earned, or been promised. Once you understand the architecture, the news will never sound the same again. The rate decisions will never look the same. The official statements will never read the same, because you will know what they are actually describing, and more importantly, what they are not. The date is August 15th, 1971. It is a Sunday evening. Richard Nixon appears on American television. His speech is 15 minutes long. He is calm, authoritative, and speaks with the measured confidence of a man announcing something routine. He's announcing the end of the world as it had existed for 26 years. Since 1944, the global monetary system had been built on a specific promise. Under the Bretton Woods Agreement, the US dollar was fixed to gold at $35 per ounce. Every other major currency was fixed to the dollar. The entire global financial architecture rested on one guarantee, that any nation holding US dollars could at any time present those dollars to the United States government and receive gold in return. This constraint mattered. It mattered enormously, because it meant that the United States could not simply print unlimited dollars. Every dollar created had to be, at least theoretically, backed by gold. If too many dollars were printed, foreign nations would notice the dilution, present their dollars for redemption, and the gold reserves would drain. The constraint was a leash, and in 1971, the United States cut it. Nixon announced that the dollar would no longer be convertible to gold. No explanation was offered about what would back the dollar instead. No vote was held. No international agreement was reached. In 15 minutes, on a Sunday evening, the architecture of the global monetary system was fundamentally restructured. The official explanation was temporary, an emergency measure, a technical adjustment to address short-term pressures. It has now been 54 years. What Nixon actually did, what that Sunday evening actually represented, was the removal of the last external constraint on money creation. Before 1971, governments had a limit. After 1971, the limit was gone. And a system without a limit on money creation has exactly one long-term trajectory. To understand why, you need to understand what money actually is in the post-1971 world. Before 1971, a dollar represented a claim on something real, a fixed quantity of gold. It was, in the most literal sense, a receipt. You held the paper. The gold existed somewhere. The paper derived its value from that underlying reality. After 1971, a dollar represents nothing except a promise. Not a promise backed by gold, not a promise backed by any physical commodity, a promise backed by the full faith and credit of the United States government, which is to say, backed by the government's ability to tax its citizens and its ability to create more dollars. This is what economists call fiat currency, from the Latin fiat, let it be done. Money that exists because the government declares it to exist. Money whose value is sustained not by any underlying asset, but by collective belief and legal mandate. Fiat currency is not new. It has appeared throughout history. And throughout history, every instance of pure fiat currency has followed the same trajectory. Gradual expansion, gradual debasement, gradual erosion of purchasing power. Not because governments are evil, because the incentive structure makes expansion inevitable. And here is the precise mechanism that makes inflation not a bug in the system, but the feature. When a government needs to spend more than it collects in taxes, it has three options. It can raise taxes. Politically painful, immediately visible. Voters notice and react. It can borrow. Issue bonds. Pay interest. Accumulate debt. This works until the debt becomes unmanageable, at which point it faces the same three options again, now with a larger obligation. Or it can create new money. instruct the central bank to expand the money supply, fund spending through monetary expansion rather than taxation or borrowing. This third option has one extraordinary political advantage. It is invisible at the point of creation. When taxes rise, every taxpayer sees the deduction. When debt rises, bond markets react and interest rates reflect the risk. But when new money is created, nothing happens immediately. The dollar in your pocket looks identical to the dollar that existed yesterday. Your bank statement shows the same number. Your salary is unchanged. The cost arrives later, spread across every transaction in the economy, distributed so diffusely that no individual can point to a specific moment and say, "There, that is when they took it from me. This is the mechanism." This is why inflation is the preferred tool of every government that has ever faced a gap between what it spends and what it can honestly collect. Not because policymakers are uniquely corrupt, because the political economy of fiat currency makes monetary expansion the path of least resistance every single time. But it goes deeper than political convenience. The system does not merely permit inflation. At a structural level, it requires it. Here's why. In the post-1971 monetary order, money is created through debt. This is not a metaphor. It is the literal mechanism. When a bank makes a loan, it does not transfer existing money from one account to another. It creates new money at the moment of lending. The borrower receives funds that did not exist before the loan was made. The money supply expands. When the loan is repaid, that money is extinguished. The money supply contracts. This means that in a debt-based monetary system, the total amount of money in existence at any moment is equal to the total amount of outstanding debt. If all debts were repaid simultaneously, the money supply would collapse to near zero. The system would cease to function. For the system to function, for transactions to occur, for businesses to operate, for salaries to be paid, debt must continuously expand. New loans must constantly be created to replace old loans as they are repaid. The money supply must grow. And a continuously growing money supply, across a relatively stable supply of goods and services, produces continuously rising prices. This is not a policy failure. This is the architecture. The system was designed, whether intentionally or through the accumulated logic of its own incentive structure, to require permanent monetary expansion. Permanent monetary expansion produces permanent inflation, not as a side effect, as the operational condition of the system continuing to exist. Sit with that for a moment. The officials who appear on television to express concern about inflation are not describing a malfunction. They are describing the cost of operation, the fever that is actually the metabolism, the symptom that is actually the heartbeat. Now look at the historical evidence, because this is not theoretical. From 1913, the year the Federal Reserve was created, to 1971, the year the gold constraint was removed, the US dollar lost approximately half its purchasing power over 58 years. That is meaningful erosion, but it is slow. The gold constraint was imperfect, but it was real. It imposed genuine limits on monetary expansion. From 1971 to today, 54 years without the constraint, the dollar has lost approximately 93% of its purchasing power. Let that register. Something that cost $1 in 1971 costs approximately $14 today. Not because the thing became 14 times more valuable, because the dollar became 14 times less powerful. This is not volatility. This is not a crisis. This is the steady, permanent structural erosion that the system requires to function. Year after year, administration after administration, crisis after crisis. The number on your paycheck rises. The number in your savings account rises. But the purchasing power of those numbers, what they can actually buy, falls continuously. The dollar in your pocket today will buy less next year, and less the year after, not because of any specific policy failure, because that is what the system was built to produce. Look at it from another angle. A worker who saved diligently throughout a 40-year career, from 1971 to 2011, and held those savings in cash, would have watched 90% of their purchasing power quietly disappear, not through any market crash, not through any bank failure, not through any visible catastrophe, simply through the steady operation of the system, doing exactly what it was designed to do. The worker who borrowed to buy a home in 1975, however, watched the real burden of that debt dissolve over the same period. The mortgage payment stayed constant. Wages rose, home prices rose. The real cost of the debt fell year after year, transferred quietly from the borrower to the lender, from the debtor to the creditor, through the same mechanism that penalized the saver. The system does not treat these two people equally. It was not designed to. One position benefits from inflation, the other pays for it. And the entity that determines the rate of inflation, that sets the target, that controls the mechanism, is the same entity that holds the largest debt in the system. This is not coincidence. This is architecture. And architecture does not change with elections. It does not change with party platforms or campaign promises or the personal convictions of whoever sits in the central bank chair. The incentive structure is deeper than any individual. It predates every current official. It will outlast every current administration. The system requires inflation. The system produces inflation. The system will continue to produce inflation, not because anyone chooses to fail, but because the system is succeeding at exactly what it was built to do. But here is where it becomes more than just a monetary phenomenon. Here is where the architecture of 1971 connects to the daily reality of your financial life. In a system that requires permanent inflation, saving money in cash is not neutral. It is a guaranteed loss. Every year that inflation runs at 3%, the person who holds cash loses 3% of their real purchasing power. At 5% inflation, the loss is 5% annually. Compounded over a decade, 3% annual inflation erodes roughly 26% of real purchasing power. 5% erodes 39%. This is not bad luck. This is the designed outcome of the system. Cash savings are penalized. Debt, paradoxically, is rewarded, because the real burden of fixed-rate debt falls as inflation rises. The monthly payment stays constant while the currency it is denominated in loses value. The system punishes savers and rewards borrowers. And the largest borrower in the system, the entity that benefits most from continuous inflation, is the government itself. You begin to see the complete picture. The government removed the gold constraint in 1971. The government issues fiat currency through a central bank it controls. The government is the largest debtor in the economy. The government benefits directly from inflation, reducing the real value of its obligations. The government also benefits from the captive saver, the person who holds cash, bonds, and fixed income assets that lose real value every year while the government's debt burden quietly dissolves. This is not conspiracy. This is incentive structure operating with perfect logical consistency. There is an argument, offered regularly by economists and central bankers, that some inflation is necessary for economic health, that without the expectation of rising prices, consumers would delay purchases, businesses would delay investment, and the economy would stagnate, that a small, stable, predictable rate of inflation is the optimal operating condition for a modern economy. This argument is worth examining honestly, because it is partially true. In a debt-based monetary system, the system that exists, deflation is genuinely dangerous. If prices fall, the real burden of existing debt rises. Debtors struggle. Defaults increase. Banks contract lending. The money supply shrinks. The contraction feeds on itself. This is what happened in the early 1930s. Deflation and debt interacted catastrophically. So central banks target positive inflation, typically 2%, as a buffer against deflation, as a margin of safety, as insurance against the deflationary spiral. But notice what is being described. The need for permanent inflation is not a feature of economies in general. It is a feature of debt-based monetary systems specifically. The disease and the cure are products of the same architecture. The system creates the deflationary risk and then requires inflation as the permanent solution to that risk. A monetary system not built on debt expansion would not have this property. Gold-backed currencies were deflationary at times, but they were deflationary because the money supply was constrained, not because debt was contracting and dragging the economy with it. The 1971 restructuring created a system that is simultaneously dependent on debt expansion and vulnerable to debt contraction. The permanent inflation target is not wisdom, it is maintenance. It is the oil that keeps the engine running, an engine that was designed to require that oil indefinitely. Now examine the present specifically. Central banks in the United States, United Kingdom, European Union, and most developed economies target 2% annual inflation. Not zero, not price stability in the literal sense. 2%, a number that, compounded over 30 years, reduces the purchasing power of a fixed sum by approximately 45%. This target is presented as the definition of price stability. A 45% reduction in purchasing power over a working career is presented as stability. When inflation rises above 2%, as it did dramatically in 2021 through 2023, officials treat it as a crisis. Emergency rate increases, urgent statements, the performance of concern. But when inflation runs at 2%, eroding savings steadily, reducing the real value of fixed incomes predictably, transferring wealth from creditors to debtors continuously, that is called success. The target is not zero because zero would threaten the system. The target is 2 because 2% is enough to keep the debt-based architecture functioning, enough to continuously erode the real burden of government obligations, and slow enough that most people do not consciously notice the loss until it has already compounded into something significant. 2% is not the absence of financial repression. It is financial repression at a socially acceptable speed. This is what the channel has been building toward across 3 videos. In the first video, we examined what happens when exchange systems fail, when stored value cannot be converted into survival because the infrastructure of exchange itself breaks down. The lesson was that monetary wealth is derivative. It depends on systems that can collapse. In the second video, we examined financial repression, the documented deliberate use of inflation to transfer wealth from creditors to debtors, from private savers to sovereign borrowers. The lesson was that this transfer is not accidental. It is policy, operating through mechanisms designed to be deniable. This video completes the architecture. The transfer is not merely policy, it is structural. It is built into the design of the monetary system established in 1971 and operating continuously since. Every unit of fiat currency created, every debt-based loan extended, every year of 2% target inflation, all of it is the system operating exactly as it was designed to operate. The inflation you experience is not a failure of management. It is the evidence of success. The system is working. The only question that matters from the perspective of an individual navigating it, is whether you are positioned as the system intends you to be or differently. The system intends for you to hold cash, to save in bank accounts, to keep the safe portion of your portfolio in fixed income instruments that yield below inflation, to trust that the number in your account represents a stable value, to measure your wealth in nominal terms and feel reassured when that number rises, even as its purchasing power falls. The system does not intend for you to understand what is happening. Understanding disrupts the mechanism. Understanding leads to behavior that protects against the transfer, rather than facilitating it. This channel is not a financial advisory service. What specific individuals should do with their own money, in their own circumstances, with their own obligations and time horizons, that is not something any video can or should determine. But understanding the architecture is not financial advice. It is literacy. And the first question that literacy suggests is simple. If the system requires permanent inflation to function, and permanent inflation permanently erodes the purchasing power of nominal assets, then what does holding nominal assets across decades actually mean for real wealth? History has answered that question repeatedly. The Manchester schoolteacher answered it with her war bonds. The retirees of the 1970s answered it with their fixed pensions. The savers of every decade in which inflation outpaced interest rates answered it with the quiet, invisible legal erosion of what they had accumulated. The answer is always the same. Nominal is not real. The number is not the value. And a system designed to continuously reduce the relationship between the two will continuously do exactly that, regardless of which party governs, regardless of which central banker chairs the committee, regardless of what the official statement says about the commitment to price stability. The commitment is real, the target is 2%. That is the commitment. Now, before you close this video, 3 videos, 3 patterns, 1 architecture. If what you have seen across these 3 videos, the collapse of exchange assumptions, the mechanism of financial repression, the structural inflation requirement of the post-1971 system, if this forensic lens is useful to you, then there is one thing I want you to do right now. Not subscribe, not yet. Think first. Ask yourself honestly, how much of your current financial position was built with an understanding of this architecture? How much of what you were told about saving, about safety, about the reliable accumulation of wealth over time, how much of that assumed a system that works the way the textbooks describe, rather than the way the history shows? That is not a rhetorical question. It is the question this channel exists to help you ask clearly. If this is the kind of analysis you want more of, if you want to understand the systems that govern your financial life before their consequences become undeniable, then subscribe. It costs you nothing. It tells the algorithm that this depth is worth surfacing to people who have never encountered it. If this video shifted something in how you see the monetary system, even one thing, share it with one person who would think seriously about it, not to go viral, because these ideas are more useful when more people are reasoning from them. The architecture affects everyone. The understanding is not yet widely distributed. And leave a comment with your answer to this question. Before watching this video, did you believe inflation was a failure of policy? Or did you already suspect it was something else? I read every comment. The range of answers shapes what this channel examines next. 3 videos, 3 pieces of the same pattern. The system is not broken. It is working exactly as designed. The only question is whether you understand the design before it finishes working on you.